Hey guys, it's Seth and Paul for the Everything Money channel. On this amazing episode, I'm not kidding.
Intense.
You will learn how to judge the current status of the market. Is it overpriced? Paul will show you his 3 incredible analytics to show you it indeed is a scary world of overpriced markets out there. Stay tuned and learn what's going to happen in the next 10 years from the great Paul Gabriel on the Everything Money channel. Let's do it, baby. Boom. Paul, I saw you arguing on LinkedIn last night. Lots of comments. You drummed up some sort of comment about the overpriced stock market, how it's not different. You do love this phrase that it's not. People will say, well, it's different this time. You know, you love analyzing history, talking about the way the market moves over the past 100 and some odd years. And you really get fired up when someone says, you know, Paul, you don't understand. It's different this time. So tell me about the stock market, and go ahead.
So they don't actually say the word, it is different this time.
Go on.
But if you go look at history and you go look at all the people who've done very well over long periods of time in investing.
Yes.
The joke that's always said is there's some variation of it's different this time.
Right.
The person who was commenting had said, Paul, you can't look at the same metrics today that you looked 20 years ago and 50 years ago and 60 years ago.
We're talking about basically the price or the general health of the stock market. Is it over, undervalued? Certainly not under, but tell me why you think it's overpriced.
Well, to finish my statement before you rudely interrupted me.
Go ahead, yes.
That's another way of saying it is different.
Speaking of rudely interrupting, go ahead and smash that like button down in the bottom right corner while I rudely interrupt Paul.
Guys,
go ahead.
It takes 2 seconds.
Please
hit
help
the
us
like
right
button.
there.
It helps us out a lot.
Thanks, guys.
It helps that algorithm.
Go ahead, Paul.
So they're basically saying today it's different, and that's why you can't look at all these metrics.
Yes.
These are things that over time have proven to always at major bull market peaks. People always say Warren Buffett has lost it. He's not the same. All these value investors, it's not the same thing. You can't look at these things. You can't look at profit. You can't look at revenue, et cetera. Ironically, I saw this before the COVID crash.
Yes.
I'm seeing it even more now. And the reason I think that's happening is people have said, hey, if COVID and this bad economy hasn't hurt the stock market, nothing will.
And this is trickling down to just normal people. I had a conversation on a basketball court with my neighbor last night, and very normal people who don't have any idea about, probably most of our viewers who are getting into investing, they can't understand why everything's down, yet everything's up. Like, jobs are down.
And I'm not going to lie, Seth.
Go on.
Internally, we're like, what the hell? Like, I've even said before, maybe it is different this time. And then I go and slap myself and say, no, it never, ever is.
Okay, tell me why.
So, this video is about, is the stock market overpriced?
Mm-hmm.
There are a lot of metrics I look at, but there are 3 main metrics that I look at to see if the stock market is overpriced.
Okay.
The first one is, and I will explain these in detail.
Yes.
The 10-year cyclically adjusted PE ratio.
Okay.
The second one is the stock market to GDP ratio, which is a big one that Warren Buffett always talks about.
Okay.
And the third one, which is lesser known, and I don't have as much historical data, but I'll get into it, is the price to sales ratio. Okay. So,
I'm eager to learn what these are.
yeah, the first one, 10-year cyclically adjusted PE ratio. I'm assuming you're going to ask me what the hell does that mean?
Yeah, right. This sounds scary and weird.
We've heard of PE ratios,
right? Yeah, so PE ratio is the price of the stock over the earnings.
Correct. Mm-hmm. So we do the same thing with the stock market. Mm-hmm. Okay. Now what this is, this has been made very famous by a guy named Shiller as of recently, but it was actually created by, I think, Ben Graham back in the day, like the 1930s and 40s. Mm-hmm. What this does is it takes all of the last 10 years of earnings, okay? It brings it, so 10-year of earnings brings every single dollar to today. So what we do is we take inflation and bring all of them into today's dollars. All the last 10 years brought into today's dollars. Mm-hmm. And then we divide by 10 for an average.
This gives me the average of every year, like the growth you're saying, or?
No, the earnings of the last 10 years.
Okay.
Now, why do we do an average over 10 years?
Well, because inflation would make the numbers not look correct, right?
Well, no, but why do we do an average of those? Why do we bring them to today's dollars? Why do we take an average of 10 years?
I don't know.
We can all agree that year to year, things can fluctuate greatly.
Okay.
So what they said was, listen, you shouldn't look at any year to year, 1 year at a time. You should take an average of the last 10 years and bring it to today, because then you'll get rid of all these fluctuations that can happen from recessions, from outlying situations, right?
Go on.
So it's a way to smooth everything out. Now, historically, Seth, what's the average on this 10 year, going back 107 years?
Every video we talk about when we analyze stocks, we like a PE of around 15 to 20.
Right. For this ratio, the average is about 15 to 16 over the last 100 some years.
Okay.
Okay, what are we at today? What would you guess?
Over that.
Today we're about 32. So it's double that. We got as high as 34 last year. So we're at double this ratio. Now, you might sit there and say, yeah, but it's different. Okay, maybe. But you got to remember, in the last 150 years, we've only been above 23 or 24 7 times.
Now, you told me this stat off camera, and I can't believe it doesn't make any, it's not adding up.
Correct. I shouldn't say it's not adding up. It's every major market peak has had above 15 or 16. We got as high as 40 in 2000, in year 2000. We got 42, I think, in the year 2000. And we can all agree that was considered probably the most overpriced market. Out of those three ratios I talked about here, those three things I look at, this is the only one where it was higher than in 2000 than today. These other two are higher today, but we'll get into that.
Okay.
So what does this mean, though, overall? What I want to show you next is when it's been above 23, what happened for the next 10 years. Okay? So let's go to that. And I have a little
graph.
I just looked it up. So in 1902, people are going to be like, oh, come on, 1902, it doesn't matter. Fine, we'll get into that in a little bit. But in 1902, it was around 23 times the 10-year CE, the 10-year CAPE, cyclically adjusted PE ratio, was about 23.
Okay.
The S&P equivalent was 8.12. Now we're at 2340. 8.12. In 1912, 10 years later, what do you think the S&P was at?
This is still pre-World War I?
Yeah. So the S&P was at 8.12 in 1902. What do you think it was in 1912?
12 or 15?
9.12.
Okay.
Okay, so in 10 years, it went up 1 point.
Okay.
In 10 years, it went up 12%.
Okay.
Total. That's less than 1% per year annualized.
Yes.
Okay. So that's an example of when the 10-year was 23. So in 1930, 1928, 29, 30, the stock market crash occurred. The S&P was 22.
Okay.
Okay. This is also a time when the PE, 10-year PE was above 23.
Okay.
What do you think it ended up at in 1940?
This is still before the war. I mean, I was, so 1%-ish, 30, 32, 34, 12.
12. Are you seeing a pattern here? This is only two events, but high PE, the following 10 years, bad returns. Okay? Let's go to another one.
Okay.
Let's go to the next event that occurred. In 1966.
Okay. I got it now.
Now we're more modern times. And by the way, all the reasons people give for why you can't look at money today. Did you see that? I wasn't even looking down at the pen.
You just fucking threw that pen in the air and caught it.
By accident, it slipped out of my hand, and I caught it while still looking at you.
Go ahead.
1966 to 1902. Do you believe people in 1966 were saying, yeah, but you can't look at 1902. It's totally different now. Technology has changed. We are able to make so much money.
Yeah, they were saying that. I'm sure.
1966, the S&P 10-year PE was like 25 or something like that.
Okay.
So higher than 22. 1976.
I mean, judging what you're going here by, this is down to 79.
No, it was a little bit better. 96.
Okay.
So 10 years later, it gained 3 points, so about 3% over a 10-year period.
That's not still that great.
That's still not great. Okay. Now, let's go to the big mamma jamma. Year 2000.
Big mamma jamma.
The year 2000, the S&P, if you remember, was at like 41 times earnings. The S&P was 1425. Does everybody remember where it was in 2010?
No.
1123. So guys, this isn't just me picking out the ones that work. Every time the S&P was over 20, S&P 10-year PE was over 23, I've shown you the results for the following 10 years. And it makes sense. If you think about it, that the more you pay for earnings today, the less return you'll get later.
Now, you love this slogan. You apply it to buying everything.
Right.
When you buy houses, say it again.
The more you pay for something today, the less return you will make in the future. People do have a hard time understanding this concept, but it actually makes perfect sense. If your shirt is worth $50, are you going to make more on it if you pay 40 or 20?
20.
Same thing. But people seem to think that the more you pay for something, the more it'll cause that thing to go up in price. That doesn't even make sense. Because in the long run, stocks are still businesses, and businesses grow in value because of their cash flow and their assets behind them.
I don't think normal people see stocks as businesses.
Of course they don't.
Right?
Normal people look at stocks as it's like baseball cards. Like, what's more popular? I want to give you this. I want to give you that. Mike Trout has a signed baseball card that's very rare, and it goes for $3.6 million. But businesses are not that way. They can be that way, but eventually the earnings have to catch up to it. So when you look at this 10 years of earnings, every single time it's been bad when it was above 23. And today we are at a 10-year of 32. The next 10 years are likely not to be very good.
Because we're already paying $40 for a $50 t-shirt, not $20.
Correct. Now, can you still make money at $40? Yeah, we've seen a couple of periods of time. You still made money. But the question is, are you going to make the same money you made that caused the stocks to go that much higher?
So when you buy real estate, you say the same thing. Like, you have to buy at a certain price to make money. It can't just be
based on appreciation. Because if you have the cash flow, like you do with stocks, if you have the dividend yield, if you see your companies generating more and more cash flow and building up their assets, people don't realize that when a company builds up its balance sheet, you own a piece of that balance sheet. It's like it's in your hands, but you don't get to control it. But the bigger and bigger it gets, the analogy I would give is, not the analogy, the exact example I'll give is, let's say you had a company that you bought a piece of, and they generated so much cash flow, but they never gave it to you. You paid $1 million for the company, for the shares of the company, basically $1 million value. And 10 years later, they had $10 million in the bank, free and clear, no debt. If it's not in your hands, it still makes the company worth $10 million just right then and there, plus the value of the business.
Yeah.
It doesn't matter if it's in your hands or not. Because it can be liquidated and they can sell the business off and give all the money to the owners. That's what would happen. But people don't look at it that way. So this is a very nice metric to look at and to see where we are today. But you got to remember, in order to get this number, you have to see stocks flying so high that people love them and they can't get enough of them.
Yes.
And that's where the euphoria comes in of saying, no, it'll get better. Or what they're doing is saying, I'm willing to pay today for what we've already gained. What they don't forget is, you're paying extra ahead of time for the gains. When the gains happen, what are they going to say? Well, the stock should go up now. But wait, you already paid for those. You already paid a lot of money for that. You already paid factoring in the big gains. Like Tesla. We're already factoring in Tesla like it sells 10 million cars a year. But you better believe if next year they sold 10 million cars, what would people say about the stock?
It's bound to skyrocket.
And my comment would be, but you already paid for the skyrocket. You paid extra today saying it's going to skyrocket tomorrow. So when it skyrockets tomorrow to the numbers you already assumed, you can't pay more for it because you already did that.
I've heard people say this. Like, I'm not buying Tesla to be smart. I'm buying it because of its growth potential.
Great. And then when it grows a ton, you've already paid for that, though.
Yes, I guess
so. At $2,000 a share, you're already assuming it's going to sell 10 million cars a year. So when it sells 10 million cars a year, due to using your reason for buying it,
yes,
the stock shouldn't go anywhere. Well, I already paid for that $10 million. You already factored it in there. And that's where I look at the stock saying, wait, based on $2,000 a share for Tesla, you're assuming it already sells 8 million cars a year. So from now until 8 million cars a year, you should get zero growth. Now, if Tesla could make 20 million cars a year, then, okay, there's an argument to be made.
Up from 400,000?
Sure. Well, no, up from your assumption of 8 million. Like, I'm going to pay for the first 8 million in growth.
I meant from 400,000 cars a year.
Yeah, correct.
Oh, I got it.
That's what I assumed you meant.
What about the second metric you look at with the stock market?
Let's go to the second metric. Now, the second metric, am I saying the word right? Yes. The second metric is the stock market to GDP ratio. Now, what this is what Warren Buffett calls to be the single most reliable metric to know where the stock market stands at any given time. What it takes is the entire stock market. It adds up all the values of all the companies. So you take all the companies up, Amazon, even the small, and you add them all together, and their total market value is
$17 trillion or something?
No, it's more than that. It's probably 35 trillion.
Okay.
And then you look at the GDP. which is around 20 trillion, and you take the ratio, 1.75.
Uh-huh.
Okay. Is that what that is? Yes, that's what that is. Now, 1.75. In the year 2000.
Oh, come on, you're going to do this again?
What do you think it was in the year 2000?
1.75?
No.
Okay.
1.4. And the year 2000 was, if you ask people what the biggest bubble in history was, they'd probably say 2000.
Uh-huh.
And I sit there and say, nope, today.
Come on.
Yep. Okay. Let me do a little sidewinder here. In 1982, what was the number? Now, 1982 is known for being one of the worst, the lowest point of stock market in history, basically, like in terms of values. To show you where it can go. In 1982, what do you think that number was?
0.6?
0.32. And what happened over the next 10 years?
Amazing growth?
Amazing growth. What happened 10 years after 2000?
Oof.
Do you see a pattern? In 1966.
Okay.
What was it?
I
don't know exactly, by the way, but I think it was around 1.2.
Okay.
So, in 1966, what was the S&P at? In 1966, we said the S&P was 93. In 1982, what was it at? It was like 107. So when it was really expensive, what return did you get? From 93 to 107, when you were starting in 1966 and it was expensive, you barely went up.
Yeah, terrible return.
1982, when it was cheap, 107, what was it in 2000, 18 years later?
14?
1450. So do you guys see a pattern forming here? When you pay more, when it was expensive in 1966, you saw less gains. When you paid less, when the ratio was low, which means you're paying less to get that same gain, the gains were huge. This has happened over, in every single date that I talked about, the 10-year PE had the exact same metrics. Expensive went poorly. Cheap went great. So now there's an image that's up on the screen right now. And that image shows, going back to 1950, this is from a guy named John Hussman, which a lot of people criticize. He's a value investor, but he's done terrible over the last 5, 6, 7 years. It shows, in blue, the market cap to GDP ratio, and then in red, the actual subsequent 12-year returns of the S&P. So as you can see, it stops because we haven't finished those 12 years. Look how accurate these lines are. How close in touch are these lines?
I mean, they're right in sync.
So right now, it shows the history of what was projected and what actually happened, very much in sync. Today, it is showing that for the next 12 years, including dividends, we should make zero on the S&P for the next 12 years. The only times it ever deviated, like if you look at these overshoots, it's when the market had major fluctuations, dispersions from the actual norm. Major market tops.
I'm sort of baffled. This is scary.
Well, it shouldn't be scary. It's just something to be cognizant of. Now, has it been wrong? It's been wrong for the last 4 or 5 years. I've been wrong for the last 4 or 5 years. But eventually, these things will probably work themselves out. Because at the end of the day, I don't care what you value things at today. Investing is about money in and money out. I'm going to put the less you put in and the more you put. What's going to happen with the companies is going to happen. Tesla, it doesn't matter if Tesla stock is 2,000 or 200. They're still going to produce X number of cars over the next 10 years, whatever the stock price does. So the more you pay for that, the less return you'll get. Same thing with the stock market. The economy and stock market are going to do what they're going to do. The more you pay for it, the less return you're going to get. And right now, we're paying astronomical levels.
Yes.
So I don't care how you look at $1 of cash flow today versus 100 years ago. It's still $1 of cash flow.
That's what you're saying in your comments. $1 is $1.
$1 of cash flow is still $1 of cash flow. And somebody might say, well, inflation, that doesn't matter. It's still $1. There's still ratios. Ratios don't care about inflation. It's still $1 of cash flow and $1 of earnings is still $1 of cash flow, $1 of earnings. I don't care when it was. The question you have to ask yourself is, what am I willing to pay for that? And these first two metrics have shown that the more you pay for it, the less return you get. This graph also shows the same thing. So you have to decide for yourself, are you going to wait? Because these things go in cycles. You see from 1950 to today, back on this graph, it's fluctuated big time. We go through cycles. There's 3 things in this world that are going to get guarantees: death, taxes, and cycles. I've added cycles to it. Cycles always happen. Nothing's ever hot and awesome forever, right? Especially in the world of investing. The thing that's popular today will not be popular tomorrow. Name me one company that over 20 years has been very, very popular stock-wise. You can't. Microsoft's popular again today, but it went through a period of 10 or 15 years where everybody considered it a dead company.
Yeah.
It was amazing in the 90s, dead from 2000 to 2010, and even dead till 2014, and then it's hot again. These things go in cycles.
What about the third metric?
Third metric, price to sales ratio. Now this one, I only have data going back to 2000, but that's what I want to refer it to. Now think about it this way. It kind of makes sense that there should be some sort of relation between sales revenue and market cap of the company, worth of the company, correct?
Sure.
The more the company makes in sales, it is not unbelievable to think that the more value it should be.
Yes.
Right? Now, this is the one area I will say I can understand the argument being made. It's a little bit different today because our economy has become more service-oriented. But when I say that as a comparison to 50, 60, 70, 80, 100 years ago, when companies were more manufacturing-based and factories and fixed assets. But in 1990 and beyond, we became a very service-oriented company. So when I compare this to 2000, that's what I'll show. It's not different from 2000. Because in 2000, we were doing a lot of technology and services. In the year 2000, the ratios that we have for the price of sales, I only have from 2000. What do you think? Just a guess. What would you think the entire S&P sales divided by the S&P price that ratio was in 2000?
Very high.
Well, yeah, but I'm throwing it out to you. I'm going to say 1 point. I'm going to tell you it's 1.8.
Okay.
What they're basically saying is, you take all the price of the S&P and divide it by the sales of the S&P, your ratio is about 1.8. But remember, in 2000, we were one of the most overpriced markets in history. What do you think it is today, Seth?
It can't be that bad, Paul. So 1.6? Oh, come on. Shut your mouth. End the video. Thanks for liking. Thanks for watching. Subscribe down below.
Well, first off, like the video because this is all good shit. This is all good content. We are 33% higher than we were, 34 or 35% higher than we were in 2000. Now, these three metrics, if you go look at history and correlations and run stats on them, they're highly correlated to future 10-year returns in the market. So why are we fighting this? It's like saying to a doctor, hey, doc, I eat McDonald's every day. I eat Doritos every day. I never eat vegetables. Well, you're probably going to have a problem in the future. Well, I'm fine right now.
Yes.
That's the exact analogy. Well, I'm fine right now. The stock market hasn't crashed. We're at 34. We're at all-time highs.
Yes.
In fact, we had a crash in February and March, and we rebounded.
Right. Love it. Everyone's loving this.
Well, would you tell your doctor, would you believe your doctor who said to you, yes, I get that, but at some point there's going to be a day of reckoning?
What if there's not, Paul?
What if there's not? Then I'm wrong.
That's
possible. Is it probable?
We've entered this weird state where things are really weird. Like people can watch the same video and think totally opposite things. Absolutely. Or people can just
data's all about interpretation.
Lie and
I get it.
On both sides, it's just lying.
I've been wrong for 5 years. So to me, especially for young people who haven't experienced a bear market, they don't understand stocks going down. And that's what's amazing about the guy who commented. I looked at him like, this guy's older. He's older than me. He has seen bears and bull markets. But that's just personalities. We always want to, I don't know what business he is. He might be in the money management business, which he needs the stocks to go up for him to make more money.
Yes.
So he has a perfect personal bias. Just like I have a bias. My bias is I've shorted the market. But my short is based on my analysis. And in 2009, when markets were crashing, I was told by bankers and lawyers I was the only positive phone call they had. Because I was always like, buy, 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 buy. I react to valuations, not to euphoria and not to depression and the news and media.
I was talking in your office before we started filming because I said, you need these dummies to do all these dumb moves to be you.
And that's the thing that's always hard is whenever I get upset, I want everybody to agree and see and go, oh my God. But then I think to myself, but if they did, I wouldn't be able to make money like this, right?
Yeah. So
it's a valid point. And I've been wrong for the last 5 years. And there will be a time when I say you should own stocks. Stocks are amazingly low. And people are going to tell me, you're wrong again, Paul. And I say, but remember, I was right before. And they're going to say, yeah, but X, Y, and Z happened. That's what caused stocks to crash. You weren't.
COVID happened.
So it's funny. All my friends tease me about this. I think to myself, okay, so when stocks go up for no apparent reason whatsoever, I'm wrong. But they want me to be exactly right as to why stocks go down. And my comment is, it doesn't matter what the reason it goes down. It will go down because of some arbitrary reason.
Yeah.
Just like a room filled with gasoline and there's a fire in the corner, you can't pick which spark will cause it to blow up, but it will blow up. If you keep fighting with your wife and eventually get a divorce, it's not the last fight that caused the divorce. It's the buildup that caused the divorce. It was just one final fight that said, you know what? We're wasting our time here. Eventually, people will care about the most important thing in a company, cash flow, and how much you pay for it. Mm-hmm. And the less you pay for it, the better your returns. That's it. The question is, do you have the patience to wait for this? I do. I have the luxury of having multiple businesses. I have the luxury of doing all these things to be able to sit back and say, I'm okay losing out for 5 years. Because I look at it and say, when it finally does hit its day of redemption, I will be ahead of the market at that point. I've trailed the market since my career started because of the last 5 years. But all it takes is one of these things working out, and I'm ahead of the market again, and I'm beating the market again. That's all I wait for, because I cannot buy things I don't understand. And I don't understand how you pay 32 times earnings when history says you should pay 15 to 16 times. I just don't get that comprehension. It doesn't register in my brain.
If you like what you're seeing, follow along with the Everything Money channel. Subscribe below. Please like this video, of course. And we've done hundreds of videos, Don, our producer, Don. And so you can follow along with how Paul analyzes stocks and companies, real estate, all of it.
We're going to do some real estate soon because I know stocks have been hot in the media now. That's why I've been focusing on stocks. But I'm going to explain some things about how we make above average returns in real estate, which if you add real estate to your portfolio, you don't have to worry about this as much on the stock market side. You can go invest back into I'm going to show in a video how you can invest back in real estate in your properties to gain more wealth, even when the market's hot.
Thanks for joining us on the Everything Money channel with Seth and Paul. See you guys.